Well, good afternoon. Happy Friday, February 27th, last day of February, our last business day of February. 2 months in the books already in 2026. And what a crazy start to the year it has been for interest rates. We're finding ourselves at the best post pandemic levels that we've seen, easily a point better than this time last year. And that has set an early start to the spring buying season. Very busy January and February, but tons of economic data coming in. We have geopolitical risks. First, let's talk about home values, because this week we got the Federal Housing Finance Agency's home price index showing that home prices nationwide were up 1.8% year over year from Q4 of 2024 to Q4 of 2025. This marks, I think it's what is this? Experienced positive annual appreciation each quarter since 2012. So we're talking about 13 years of quarterly home price appreciation as reported by the Federal Housing Finance Agency. That is unbelievable, and one that I think may be in jeopardy as we move through the balance of 2026, finally seeing home prices start to plateau and even decline in some areas. If you look through this report, and I'll scroll down just a little bit, you can find this, of course, it's publicly available. This shows home price appreciation over the previous 4 quarters. Of course, the big spikes here coming out of the pandemic and then slowly starting to decline. Again, this is nationwide. If we continue to scroll down, they've got this map that shows the 4 quarter home price change by state. And when we zoom in on Georgia, you can see for the entire state of Georgia, we're actually down minus 0.2% for the entire state. Now, that of course includes everything, not just Metro Atlanta. Florida's seen a decline there, Texas a decline, a little bit up in the other southeastern states, and a lot of appreciation throughout the Northeast and the Midwest. Some declines out here as you move towards the West Coast. And if we scroll down the page a little bit and take a look at the price change, the blue shaded areas are the price change from December of 2023 to December of 2024. Seems like so long ago. From December of 2024 to December of 2025, a much more realistic and lower rate of appreciation. There's the overall number. But you can see over here in the South Atlantic, our region, we're down about 0.1%. And my hunch is we're going to continue to see that plateauing. I don't think we're going to see anything in the data that would tell us that we're going to have some sort of issue with home prices actually starting to decline, at least dramatically, but certainly a plateau in terms of what's happening with home price appreciation. That's likely to continue as we move throughout the year. One thing certainly to mention here is the rising potential military tensions around the United States and Iran. A lot of military equipment, including ships, have been moved into an area that would tend to indicate that we're about to have a military conflict with Iran. Historically, whenever we enter into these kind of conflicts, there's a flight out of stocks and into bonds, and we actually see mortgage rates improve on that news. That's been thrown a little bit into turmoil in recent memory as there are so many alternate investments and alternate places to put your money in times of volatility for the S&P 500. But it will be interesting to see how that plays out. Of course, we got some hot news on inflation last week, hotter than expected personal consumption expenditures. That's the Fed's favorite measure of inflation. And then here today, getting a hotter than expected reading on the producer price index, probably the least impactful of all the inflation reports, but still pointing to wholesale inflation being a little bit hotter than the Fed would like. It's going to bring up a very interesting dynamic at the next Fed meeting. Doubtful that we'll see any cuts there, although maybe not, don't take them all the way off the table. Perhaps later, once Kevin Warsh is the chairman of the Federal Reserve, we might see cuts as we move towards the June timeframe. But for now, I would expect no major action from the Federal Reserve, given that labor really has not broken yet, and we still don't have inflation back in the bag at 2%. Of course, we'll keep our eyes on these geopolitical risks, and if I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.